Hello and welcome to today's Premium Account ASX Top 50 Short Form Market Update for the 25th of June. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, current Managing Director of Global Equity Management and the Investment Manager for the Investor Signals Unit Trust. Up on screen is a graph of the Dow Jones. Now, if you follow the recordings over the past 6 months, our broad-based view is that the equity market in the US is starting to reach full value and we're facing a consolidation period whilst we wait for synchronized global GDP to develop in the back half of this year, and that's really a result of the stimulus that the ECB is providing, where the Eurozone is the missing link to global growth, will start to contribute, and we'll see a gradual re-acceleration in GDP, which will lead to top-line revenue growth, driving earnings rather than predominantly cost-cutting and share buybacks like what we've seen over the past short while. Now, up on screen is the Dow Jones. We've had a slight pullback last night. To put that into context, though, there was positive manufacturing data out both in China and the US over the last sort of 48 hours. The housing data in the US continues to look strong. I don't think there's any structural problems with the market that puts equities at substantial risk. I think the downside risk that you need to be comfortable with is up to about 10% in equities from current levels. I think still this low interest rate environment and central banks supporting equities should continue to lead to a support level under equity markets and a gradual re-acceleration in the back half of this year. Looking at the Australian market, the XJO, the shaded section on screen shows where I think the XJO will spend most of the time at about 14.5 times forward earnings and on just over a 4% dividend yield. Our market's well supported with about 5 to 6% earnings per share growth. Not a lot of that's coming from the mining sector. The bulk of that's coming from industrials, property trusts, consumer staples, telco, and we'll have a look at those numbers specifically as we roll through the top 50 shortly. Before I do that, up on screen's a graph of the Aussie dollar. So we've seen comments out of the Federal Reserve last week where they've indicated that any pickup in inflation data is really noise. So Janet Yellen, really what she's saying there is the Federal Reserve doesn't intend to be ahead of the curve on inflation. They'll let inflation pick up a little before they really start to worry about raising interest rates in the US. What that's mean is it's been a dampening effect on the US dollar, and as a consequence we've seen the Aussie dollar perform strong in that environment. At around 93, 95 cents, you'd have to say that the Aussie dollar is probably running in a resistance, so some of these US dollar earners are worth taking another look at as the market's sold off. And in today's report, there's 4 or 5 names that I think are extremely compelling buying that you need to take advantage of now. There's 4 or 5 names that I think need to be added to portfolios, and there's 2 or 3 names that we'll look at that are very good value that provide better growth opportunities short term. But in today's recording, there's certainly 4 names there that I'll focus on that I think provide a very good defensive buying opportunity at the moment. On that note, let's move straight into them. So AGK, trading at about 14 times earnings on a 4.5% dividend yield. I don't think AGK will meet market expectations for next year's earnings growth, probably somewhere in the order of 5% rather than 10%. Nevertheless, on a 4.5% yield down here at $15, they're a buy. We own the stock at lower levels. We've sold the covered calls. We're collecting the premium, collecting the dividend, and driving about 10% cash flow out of AGK, so it's really an income contributor portfolio. Asiano, this story is all about cost control. There's not much in the way of top-line revenue growth. The company will probably deliver something in the order of 3 to 5% maximum earnings growth in the 12 months ahead. I've got the stock trading at about 14.5 times on a 2.5% dividend yield, so I think it consolidates here and not our preference within portfolios at the moment. Amcor, we've seen the stock excuse me, come off a little as a couple of analysts have downgraded their earnings only by a percentage point or two. I still think it'll deliver somewhere in the order of 7 to 8% earnings growth. With the Aussie dollar up at these levels, we don't get the benefit of the conversion of US dollar earnings back to a low Aussie dollar. In saying that, the company's just come out in the last 24 hours and highlighted or informed the market that they're going to be reporting their earnings in US dollars. So in some ways that currency translation becomes irrelevant going forward. But the underlying business still growing well on about 7% underlying earnings growth, 4.5% dividend yield, 15 times earnings. The stock provides support down here at around this $10 level. We've sold the covered calls predominantly up at around $11, driving about 10 to 12% cash flow out of Amcor. ANZ, I still think the Australian banks, being ANZ, Westpac and NAB, provide 5% capital growth from where they are at the moment coming into their next round of dividends. Obviously that won't be until October, November, but the strategy is to continue to own these names. If we get a squeeze a little bit higher, then sell the covered calls. In a lot of instances where we own them at lower levels, we've already capped ANZ up at around $34 into next month. Westpac we're capped at higher levels, which I'll look at when we get to those stocks. For the Australian banks, underlying earnings growth somewhere around that 3 to 5%, I think, is the range. ASX, good value down here. It's trading at about 17 times earnings on it, just over a 5% dividend yield. I think the company can deliver maybe 5% earnings growth going forward, but it's a good defensive cash contributor portfolios, owning it here, selling the covered calls, a combination of the call premium, the dividend, delivering around 10 to 12% cash flow. AZJ was one of our high conviction sort of buys down here at around 470, 480. As it trades up to around $5, we sell the 525 covered calls, effectively giving us an exit price up at around 535. We've already collected 20 cents of premium on AZJ through this previous consolidation period, but for new money that's stepped in here as the stock rallies, we'll look to cap out those gains around 525. I don't see it pushing too much above that level in the back half of this year. BHP, this is the only resource stock we currently have exposure to. We're really positioned around this on the basis that the company's likely to announce a share buyback in August. The fact that they have a large exposure to the energy sector as well, so diversified away from sort of that iron ore focus that, say, Rio is. So our preference here is BHP, not looking for much in the way of forward earnings growth into 15, given that we've seen spot iron ore prices pull back as much as they have. However, trading at around 12 times earnings on about 3.5% dividend, I think the stock's good value. Combine that with a buyback, it could push back up to $38 quite easily. And also, I think what needs to be taken into consideration is that the iron ore trade's probably pretty close to sort of that capitulation point that I've spoken about, where we'll probably see iron ore bounce back up to around 110 a tonne. Brambles, I think this is one of the definite buys. So out of the 4 definite buys in today's recording, Brambles down here at $9. I think we'll see this back up at $9.50 before too long. A combination of getting some counter exposure to the Aussie dollar. I think if we see any strength in the US market, the US dollar improves, the Aussie dollar pulls back, Brambles benefits from that. But the underlying business is growing about 8%, and on a 3.5% dividend yield, I think it's a strong buy down here at these levels. CBA coming into their August dividend, stock should continue to be well supported with option expiry tomorrow, where we're delivering CBA. We'll be looking at possibly buying back in if the stock was to pull back below sort of $78, but I think there's probably better value elsewhere in the market, and I'll have a look at some of those names as we roll through. Coca-Cola, the strategy here is to look for this to recover into the August dividend at around $10. We'll look to sell the 10.25 calls and drive some added cash flow out of Coca-Cola whilst we wait for the stock price to recover over the next 12 to 24 months. Computershare, this continues to remain expensive, but any small sell-off, the stock is bought up quite aggressively. The stock's trading at around 20 times earnings on a 2.5% dividend yield, so I think there's better value elsewhere in the market, but the underlying business should grow at 5 to 10%, so well supported. Ideally, we want to be a buyer of Computershare on a pullback below $12, but we'll continue to wait and see whether that opportunity presents. CSL, this sits in the definite buy opportunity in today's recording. CSL, 10% forward earnings growth. The company still has around $100 million to go in their share buyback, which on my calculations based on the current run rate means that there's roughly 2 months of company buying to continue to occur. I think the stock's good value down here, should rally back up to around $70. Crown, this is one of the higher risk buying opportunities, but a sell-off down here into this $14.50 range, I think we'll see a bounce back up to around $16, so worth keeping an eye on that one and putting that on the watch list. Dex's not doing there at the moment. Goodman Group, I've spoken about these property trusts compressing down to a dividend yield of around 4%, starting to get expensive, and we're beginning to see share price struggle up at these levels. GPT, we own this at lower levels. We're taking profit effectively at around $3.85 after owning it at lower levels. We'll wait and see what happens over the next month or so. If the stock pulls back and we can jump back into it around $3.70, $3.50, with somewhere within that range, we'd definitely look at it. But I think most likely what we're likely to see is a consolidation move sideways here in GPT as the stock sort of moves around that 5.5% dividend yield. The underlying earnings for the company growing at about 6 to 7%, which is at the top end of the property plays. IPL, this is in the same category as Crown. I think we'll look back in 6 months' time and recognise that these are pretty deep discounted buying opportunities for Crown and IPL. I think at 4.5% dividend yield, forward earnings growth of about 5 to maybe 8%. I think IPL can trade into the back half of this year back up to around $3 to $3.10 is the target there on IPL. Lend-Lease, always been of the view that up at around $13.50 it's getting expensive. It puts the stock on a PE of around 14.5 times on a 3% dividend yield. I think the earnings uptick in Lend-Lease is still 12 to 18 months away, so it is a buy on the dip, but we're really at around $12.50 happy to take another look at jumping into Lend-Lease. Macquarie, I've spoken about this. I think short-term 20% earnings growth already priced in. The stock's a little bit expensive for my liking. On a 4% dividend yield, and as I'd mentioned, forward earnings growth of around 20%. I think the company's going to be stretching it to meet market expectation over the next 6 to 12 months. So that needs to be considered there with Macquarie. NAB, I think, is okay value down here. The prospect of them spinning off the UK banking division or even just in light of better economic conditions in the UK, leading to an improvement in impaired assets and loan growth in the UK, I think underpins NAB. So comfortable with some exposure to NAB, but certainly the better quality is Westpac and ANZ there, I think, within the Australian banks. Newcrest, as I've mentioned at the beginning of the recording, the slight pickup in some of the inflation data has fed through to a bounce in gold. That's helped Newcrest to move off its lows. This really, I think, is a 24-month recovery story in Newcrest. I think gold can trade from 1,300 an ounce back up to 1,500 an ounce. In that environment, Newcrest could recover maybe $17 to $19 as a price target, but I think we're only in the very early stages of the market starting to look at the inflation picture, and I really think we're probably still 2 years out before it becomes a central part of sort of market thinking. Origin Energy, the prospect of a rights issue weighing on the share price, but at around $15 I'd always sort of maintain that the stock is getting expensive. That puts it on about 20 times earnings on a 3.5% dividend yield, so we were selling the covered calls up at around $16 and capping those gains in Origin. Those covered calls will wind off and we'll collect the benefit of that premium. The stock will pay its dividend in August, and we'll look to sort of manage the position through what I think will be a floor or consolidation in Origin at around $14. As the stock rallies back up to around 15, we'll look to resell those calls again. Uh, it's worth having some exposure to Origin in portfolios ahead of the upcoming rights issue, as I think that'll sort of create the ultimate support or base level post that rights issue for Origin, then to have another rally higher. Oil search, we're not doing there in oil search at present. Ramsay Healthcare, I'll come back and revisit that in the weeks ahead. We've seen this separation proceed with WDC and WRT, so WRT now becomes SCG, which is Centre Group. Stockland pays its dividend tomorrow, roughly around 12 cents. We've been long Stocklands off this 350 level, letting it rally up to this level, collect the dividend, collect the call premium, instead of sort of getting the traditional 5.5% yield out of Stockland. We're driving around 10 to 12% cash flow from the call premium and the dividend there. Stockland should grow earnings at around 5 to 7%. Sonic Healthcare, this is one of those names that I think is worth buying on this pullback here. I think coming into the August dividend on a 4.5% yield, 5% underlying earnings growth, Sonic Health should rally off this support level here and move back up towards around $17.50 to $18 coming into the dividend. As it starts to rally into the dividend, we'll take advantage of then selling the covered calls into probably December to complement that income and drive that 4.5% yield closer to our target of around 10%. Santos, we own at lower levels. We'd capped it out at around this sort of 1480 level. So again, what would traditionally be a relatively low yield on Santos of around 2.5%. If you combine it with the call premium, we're getting closer to 10% cash flow out of Santos. I think within the oil and gas space, Santos is probably best relative value. It'll move sideways. The real added cash flow from Santos and the increase in the dividends still 12 months away, but I think the stock consolidates for the next 6 months and then gradually starts to move higher into the early part of the new year. So in that environment, we're happy to collect our 10% cash flow from the dividend and the call premium. Transurban goes ex-dividend tomorrow, roughly around 19 cents. It's pretty expensive up at these levels, so the strategy here is where we own it at lower levels. Again, we've sold the covered call, complementing that sort of 4.5% dividend yield and driving that cash flow up to around 10% through a combination of the call premium and the dividend. Telstra, this pullback puts the stock on about 5.5% dividend yield. The company should deliver around 33 cents of earnings per share in 2014. I don't see the uptick in 15 being substantially more, maybe another cent. So we could see the dividend yield increase from sort of 28 cents or 29 cents up to 30 cents over the next 12 months. But really the play here is coming into the August dividend, we should see Telstra move a little bit higher. In most cases, we own it at lower levels. At the top of this rally, we took advantage of selling the December calls at 5.41. So again, turning that 5.5% yield into a roughly a 10% yield, and still providing the opportunity for capital growth in Telstra up to 5.41. For new capital that's available, happy to be a buyer of it again here on this pullback. I think as it rallies into the August div, the same opportunity exists, which is to sell the covered call at that higher level. Toll, not much in the way of earnings growth, a little like Asiano. This is about the company being disciplined on cost control. There's not much on the top line revenue. I think on the next 12 months, the company won't deliver much in the way of earnings growth. Therefore, down here at around 12.5 times earnings on a 5% dividend yield, the stock's okay value. Anywhere up at around 5.50, you need to be looking at selling the covered calls. Westpac, as with all the banks, up to 5% growth, capital growth from where we are, but and that's on a 6-month view, but nothing much beyond that. We own it at lower levels. We've sold the covered calls up at around 35.50, so we're collecting that premium and again driving that dividend yields from 5.5% up to 10% cash flow. Here's one of these names that I think is worth taking advantage of for capital that's available at $41. I think Wesfarmers pushing back up towards a 5% yield. As it comes into the August dividend, I'd expect to see the stock to accelerate back up to around $42 to $43. At that point, it's time to take advantage of selling the covered calls and driving that cash flow from 5.5% up to 10%. Wesfarmers, good defensive income play for portfolios. The new code for WDC, which is now WFD, so we'll revisit that next week. As I alluded to, we've seen sort of that transaction go ahead, or the separation of the Australian New Zealand property assets out of Westfield Group into what is the old WRT, or Westfield Retail Trust, now renamed Centre. Worley Pass is not doing there at the moment. Woolworths, this is one of those four stocks I think need to be taken advantage of on this current pullback. Woolworths is now pushing back up to around a 4.5% dividend yield. I think again coming into the August, or in Woolworths case it's an early September dividend, the stock price should push back up to around $36.50. That's the time to take advantage of selling the covered calls and driving that cash flow higher from the dividend and the call premium. Woodside Petroleum, we've largely taken profit here on Woodside. We owned it at lower levels. We've taken profit. If we were to see the price pull back down to sort of sub $40, happy to take another look at Woodside. And there we are for a recap of the Australian market. So from a strategic standpoint, or a portfolio strategy perspective, we're allowing for a little bit of volatility as both the US and the Australian market really bump sideways over the next, say, 3 to 6 months. Ultimately, I do think we'll see synchronized global GDP lead to top-line revenue growth, which will feed into underlying earnings per share growth. But right at the moment, the Australian market will scrape through at a maybe 5 to 7% earnings growth in 2014, and the US market, we're gradually seeing the earnings expectations come down in the US, but it actually is not resulting in substantially lower share prices. We've seen the expectation for the US come back from around 9 to 10% earnings growth for this year down to around 7 to 8% earnings growth. So it'll be interesting to see as we get through the June quarter and we see the earnings results for the US come out in July, as to how that run rate's tracking, as we're starting to see the weather warm up in the US. And then obviously in the Australian market, we have earnings season in full swing towards the end of July, August, with the bulk of the market going ex-dividend throughout August and September as well, which should help to underpin any sell-off in the Australian equity market. Thank you for listening in. If I can help you with your portfolio management, we provide a managed broking account service where I work in partnership with you to help allocate the assets in your portfolio around our model and overlay the derivative overlay to enhance the cash flow from your portfolio. If you'd like more information about that, please contact me on either the number on screen or the email address. Thank you for listening in.